Well, hello and a very warm welcome to this Scope webinar on the outlook for UK banks' asset quality. My name is Keith Mullin and it's my absolute pleasure to be hosting this short session for you. I'm delighted to be joined today by Pauline Lambert, an Executive Director in the banks team of Scope Ratings, who in a few moments will take you through a short presentation. Before we start, though, I just wanted to draw your attention to the fact there is a questions function on the platform. And so I would encourage you to, as Pauline is speaking, as questions occur to you, please feel free to pose the questions that you want. And once Pauline is finished, we'll move to some Q&A and we'll endeavour to answer those questions. Now, today's webinar was in fact the subject of a research piece that Pauline published on April the 27th, which was entitled UK Banks Asset Quality Improves as Vaccine Success, Government Support Lift Economic Prospects. And we thought it would be a useful service to the market to create a level of interactivity if we followed up with this short webinar. And so where Pauline can summarize her thoughts, and then, as I said before, you can just ask some questions that occur to you. So without further ado, be delighted now to hand over to Pauline. Pauline, hi. Pauline, by the way, is actually dialing in on audio, but hopefully we should be able to hear her well. Pauline, welcome to you, and let me hand over the floor to you.
Thank you, Keith, for the introduction, and good afternoon to everyone. Thank you for joining us today. I will provide a short overview of where the major UK banks currently stand in terms of their asset quality, and then look at some things that might impact how this may evolve going forward. So earlier this month, the Bank of England revised upwards their macro forecast for the UK. The drivers behind this were falling new COVID cases, a good rollout of the vaccination program, and the easing of restrictions on economic activity. Since early March, schools have been open. Since mid-April, non-essential retail, personal care premises, and public buildings have reopened. And last week, indoor hospitality and entertainment venues have opened. We are now waiting for the last stage of reopening, which is scheduled for late June, which would lift restrictions on larger gatherings and the work from home policy. GDP is now projected to increase by over 7% this year, compared to a decline of nearly 10% last year. Unemployment is now projected to be 5%, compared to a forecast of 6.5% in February. These forecasts are based on the assumptions that most restrictions on economic activity will be lifted by the end of June, and that consumers will spend around 10% of the additional savings that they've accumulated over the next 3 years. Importantly, the government's furlough scheme runs until the end of September. The assumption is that most employees will return to work when the scheme ends. This quarter, an average of 2.75 million employees are on furlough, with this expected to decline to 500,000 in the third quarter. Risk is still to the downside in the near term due to risk from new COVID variants and potentially weaker worldwide growth. As well, households may be more cautious with their spending, limiting the economic rebound. Against this backdrop, I would now like to look at some of the factors which have been supportive for the asset quality of UK banks. First is the important weight of household lending compared to corporate lending. Mortgages account for nearly 70% of loans outstanding and have a good loss history. Over the last 30 years, they've accounted for less than 5% of credit losses. Meanwhile, unsecured consumer lending accounts for about 10% of balances, but over 50% of credit losses over the same period. Compared to mortgages, unsecured consumer lending accounts for a much smaller proportion of loan books. During this economic downturn, volumes have actually declined to such an extent that it has been a revenue headwind for banks most exposed, such as Barclays and Lloyds. The banks continue to grow their mortgage portfolios, and there appears to be some structural support for the mortgage market due to changes stemming from the pandemic, such as a desire for more space and the ability to work remotely. As well, government schemes continue to provide support. The Help to Buy scheme has been extended until 2023, and a new mortgage guarantee scheme is in place until the end of 2022. Further, since last July, the level at which stamp duty applies was raised to £500,000 from £125,000. From the end of next month, there will be a staggered return to previous stamp duty rates, with rates expected to return to normal from October. Mortgage portfolios have continued to show resilience during this economic downturn. From March of last year to March of this year, banks offered almost 2.9 million payment deferrals of up to 6 months to their customers. This has kept the number of mortgages in arrears near historical lows. And this is the case if one goes back to 2010. The proportion of loan books subject to payment holidays has declined and was low at year-end, less than 2%. This trend continued in the first quarter. For example, NatWest has seen the proportion of its corporate loans subject to payment holidays decline to 2% from 4% at year-end. The experience from expired payment holidays has also been good, with most customers returning to making normal payments. Lloyds has seen 94% of retail customers resume payments when their payment holidays ended. At the same time, banks have more limited exposure to those sectors most hit by the pandemic, such as retail, hospitality, and aviation. In the chart on the right, we've also added commercial real estate, as we believe that this is also a sector worth mentioning and monitoring. In the latest report from bank agents across the UK, which contained intelligence collected from January and February of this year, so before the lifting of restrictions, we would highlight the following findings. First, the recovery continues to be mixed. Second, companies in most sectors reported having large cash reserves, although contacts in hospitality and non-essential retail reported depleting cash buffers. It appears that many businesses which had obtained financing through government loan schemes had not used the funds. And third, agents reported lower levels of investor activity, especially for some types of retail premises. But the demand for industrial, logistics, and science-related premises remained strong among investors and tenants. Further, a large proportion of contacts expect to reduce office space, especially in high-rent areas, such as London. Valuations for office premises have so far held up. This may be due to the fact that lease contracts remain in place and have not yet come up for renewal. Under the government loan schemes, more than £75 billion has been dispersed to businesses, a level that's similar to that seen in Spain and Italy, but well above countries like Germany and the Netherlands. There is some uncertainty about the ability of borrowers to repay their loans. These loans, however, account for less than 5% of the loan books of the large banks, and the schemes actually benefit from 80% or 100% government guarantees. Of the $75 billion granted, over 60% were through the Bounce Back loan scheme, which was targeted at the smallest businesses. Under this scheme, loans of up to $50,000 were available. The first repayments are now only coming due, and there are options to further extend the term of the loans to 10 years from 6, to reduce monthly repayments by paying interest only, and to take a repayment holiday for up to 6 months. There continues to be important support for businesses impacted by the pandemic. A new £75 billion recovery loan scheme was put in place in April and will run until year-end. The loans benefit from an 80% government guarantee, with the loan size ranging from £25,000 to £10 million. Businesses who have borrowed under the earlier schemes are eligible, although the amount they can borrow under the new scheme may be limited. Asset quality has so far held up, although lenders expect some deterioration to come. This can be seen from the results of the credit condition survey published last month. This quarter, lenders expect the change in default rates to increase for small and medium-sized businesses, but to remain unchanged for large businesses. Lenders also expect the change in default rates on secured household loans to increase further this quarter. In 2020, banks incurred credit costs that were more than double what they were in the prior year. The increase in the cost of risk was driven by changed macro assumptions under IFRS 9, as well as management overlays. Some overlays were already in place prior to the pandemic because of Brexit uncertainties, but were further increased. As seen in the chart on the right, credit impairments were equivalent to 15 to 30% of operating income. Compared to previous periods of economic stress, the impact on earnings has been largely manageable. Credit costs, however, still absorbed from 45 to 110% of pre-impairment operating profit. Meanwhile, the change in the level of Stage 3 loans was much more modest. As seen across Europe, the use of Stage 2 loan classification varied. Some banks, like NatWest and HSBC, saw more than 100% increase in loans classified as Stage 2. The increase in Stage 2 loans was generally also higher for commercial than household exposures. This has been accompanied by a reassuring increase in the stock of provisions. At year-end, between 6% and 21% of loans have been classified as Stage 2, up from 4 to 11% at the end of 2019. The question remains whether banks have sufficiently identified exposures that are at risk, and as well whether Stage 2 loans will turn into actual losses. Encouragingly, at year-end, 90% or more of Stage 2 exposures were performing and not past due. When banks announced their year-end results, they had guided to lower credit impairments for this year. And with the release of Q1 results, banks generally further improved their guidance. For example, Lloyds updated its guidance to a cost of risk of less than 25 basis points from less than 40 basis points at year-end. At the same time, management teams highlighted that losses were very low in the quarter and that this was unlikely to continue. Banks that updated their macro assumptions under IFRS 9 booked impairment releases. The consensus base case appears to be for unemployment of 6% and GDP growth of 4 to 5% for this year. Others, like NatWest, did not update their macro assumptions, but saw an underlying improvement in credit risk. Their guidance for the cost of risk remains at or below 30 to 40 basis points. In the first quarter, we saw that the proportion of Stage 2 loans declined somewhat, while the proportion of Stage 3 loans was unchanged or declined slightly. Notably, the banks indicated that they would continue to maintain their provisions and management overlays over the next 12 to 18 months, as they expect credit losses to materialize. As you can see from the chart on the right, the level of allowances remains close to year-end levels. Lastly, I would like to discuss an evolving risk for the asset quality of banks, climate change. In April 2019, the UK regulator issued its supervisor expectations for banks and building societies to manage their climate-related financial risk. They are now expected to have a strategic approach for doing so by year-end. And next month, the Bank of England will launch its climate stress test involving the largest banks and insurers. What we're seeing is that banks are identifying their exposures to sectors at risk to climate change, although the caveat is that all customers within a sector may not be subject to transition risk. Some are also incorporating this risk into probabilities of default. And in regards to mortgage portfolios, work is being done to evaluate flood risk as well as transition risk from tighter efficiency standards. From the disclosures, it is relatively difficult to draw conclusions about the impact on loan books. This is an area for further work, and we do expect disclosures to improve as there is demand from various stakeholders for this information. So just to conclude, certainly things are evolving and there are factors that will impact the asset quality of UK banks, but in light of the earnings and the guidance that banks have provided about what they see in terms of credit costs for the year, it appears very manageable. With this, I would now like to hand it back to Keith for any questions.
Okay, thank you very much indeed for that, Pauline. So please do put your questions into the questions box on the platform, and Pauline will do her best to answer them. Pauline, while we're waiting for questions to come in, there's a couple I had which I just noted down from your comments, which I perhaps could ask you. You touched a little bit on commercial real estate, and you did mention that there hadn't been much movement, but that that was potentially due to unexpired leases, which could the consequences of the renewal process could be interesting. I was wondering if you could just elaborate on the potential risks you see to the UK banks related to CRE.
Mm-hmm. Yes. Well, I think the first thing to highlight is that the exposure that the UK banks have to commercial real estate has declined significantly from the days of the last crisis. The UK banks are no longer the largest lenders to commercial real estate companies. And we've seen that, I think on the whole, they're about 45% now. If we look at specific exposures that some of the large banks have, like Barclays, like Lloyds and NatWest, we see that the loan to values on their commercial real estate portfolios are around 50%, which is a reassuring level. And if we look closer to see how much of that is actually been classified as stage 3, so far it remains very low, around the 5% level. But there are certainly some question marks going forward. There's been a lot of talk from various companies about hybrid working models going forward, and how does this play out in the end? I think informally, when I speak to investors, and as well as when I look at more formal studies done by market participants, it seems that most companies are talking about hybrid working models, but don't have firm plans in place yet about what this will look like. So interestingly, Deloitte does I think twice a year, they do a survey of commercial real estate of developers. And they came out recently with some information about the London market specifically, where they did speak to developers and surveyed them. And their feeling was that there may be a decline in the use of office space, potentially by 10 to 15%. And this was due to the fact that although tenants would like to reduce the use of office space, they might actually need more space because they want to have lower density or less hot desking or have more room to do collaborative work. And so therefore, you still might need to maintain a certain amount of space to accommodate these new designs. The other factor they pointed out was that it was very sector specific, that in some sectors, like banks, for example, where the revenue outlook is not necessarily so positive, that banks would be looking to reduce space, but in other sectors that were doing well, like technology, that they actually might be interested in acquiring more space. So it's certainly quite a mixed picture, and I think it's still something that we have to watch.
Indeed, absolutely. Thank you. Pauline, we have a question which has come in, which obviously is a very big topic. I think it's easy to forget almost, remarkably, that prior to the pandemic, we had the incipient impacts from Brexit. And so the question is there any material update to UK banks' risk, either positive or negative, due to Brexit?
Yes. I think pre-pandemic, when we thought about Brexit, we saw sort of two different aspects to it. One was the direct impact on banks themselves and in their operations. And I would say that banks prepared for a hard Brexit. They had to do this. They were hoping for something better, but they had to prepare for the hard Brexit. So they reorganized their operations, they moved people to Europe, and did what they have to do so that they can continue to operate and serve customers. So I think that has been largely done by the UK banks. The question of, is there going to be equivalence or passporting for the financial sector? I think this is something that is pretty clear that this is not going to happen anytime soon, and that the longer it takes for anything like this to be achieved, market participants will just move on because they have to. They can't forever sort of, stay waiting to see what might happen. So in this respect, there will be some knock-on effects, I guess, on the economy going forward. And certainly the other aspect is, what happens to the economy. So, I mean, in light of the pandemic, the magnitude of this has been so large that it probably dwarfed anything that, might have come from Brexit. And certainly there is still some friction related to trade and what this means for the UK economy. But I think it's very difficult to split out from the impact of the pandemic. And, I guess the important thing is that we are seeing some recovery in the economy that's going to happen this year.
Indeed, yes, and absolutely. Thank you. Now, in fact, the slide's still showing there. You talked about credit risk. And I think this is a new kind of unknown factor that analysts like yourselves are starting to get their heads around, which is how do you factor credit risk factors into climate change risk? How material do you think could credit risk from climate change actually be?
I think that's a very good question, a very open question. We may get further details when the Bank of England does its stress tests, because one of the goals of the stress test is actually to try to quantify this risk, to see how large this risk is, and which means that the banks themselves have to review their own exposures. They have to do scenario analysis to quantify this risk. Banks are certainly making efforts in this direction, but from the disclosures, it's still quite early to draw conclusions. HSBC was quite unusual in the sense that they did look at their UK and Hong Kong mortgage portfolios under 3 different scenarios. And they said that based on their initial findings, it appeared that this risk was going to be limited for them, at least for this portfolio. But then certainly you have corporate exposures. And when you have regulators and central banks being very focused on this issue and trying to move to net zero, I think that will impact all corporate clients in some way. And this will then, mean that it has consequences and implications for the loan books of the banks themselves. So I think difficult to quantify, but it certainly is, I think, a relevant and material issue that we're going to find out more about in the near future.
No, absolutely. Yes, thank you for that. You talked about provisions, bank provisions in your comments. Could you just recap your thoughts there about current provisioning levels, what the banks might do around provisions in terms of dealing with the potential kind of lag effect of rising delinquencies? Are we going to see more provisions, some release of provisions? And I guess you talked about cost of risk, but could you just kind of generally summarize your thinking on provisions here?
Yes. I think the thing to note is that the banks still expect to take provisions this year. Banks that have given guidance, that has ranged from anywhere from 25 basis points to 40 basis points. So moving to levels that would be sort of the normalized level across the cycle. Previously, banks had talked about, achieving this level in maybe two years' time, but they've improved their guidance such that they expect to see that closer to this year. So they still expect to take charges. At the same time, they have made a fair amount of provisions last year. And the hope is that, those are going to be sufficient to cover the losses that will materialize later this year. So, yeah.
Okay, excellent. Thank you very much. We are going to close the session for those of you dialed in a minute or two, unless you have any last minute questions. So there's nothing in there at the moment. So failing that, let me thank you all, first of all, for dialing in and listening to Pauline. Thank you, Pauline, for the time and your very insightful comments. We'll be back for more webinars as we go along. I think that we're evolving a kind of dual track model of publishing research and on selected topics, following up with webinars to create a level of interactivity and a kind of response mechanism from market participants. So hopefully we'll be back with more banking webinars very soon. And so on that note, let me close the session formally. Thanks again to everyone, and look out for the next session, and we'll see you soon. Okay, goodbye for now.
Thank you.